Hello and welcome back to yet another exciting week on the stock market. In this week's episode, we will look into the financial news, then we will take a closer look at my portfolio and look at all the news within the portfolio, and there is a lot to cover today. So let's start by taking a closer look at the new report from IMF, the World Economic Outlook, since they have updated their report, and it does not look good, to put the least. I'm not going to go through the entire report since the report is a 20-page document, but I'm just going to highlight some of the facts so you can see them for yourself. And I will of course include a link in the description below so you can go and find it yourself. So the title, A Crisis Like No Other, an Uncertain Recovery. So global growth is projected at minus 4.9% in 2020, which is 1.9 percentage point below the April estimates. So the pandemic has had a more negative impact on the activity in the first half of 2020 than initially anticipated, and the recovery is projected to be more gradual than previously forecasted. In 2021, global growth is projected at 5.4%. Overall, this would leave 2021 GDP at 6.5 percentage points lower than the pre-pandemic levels, which was projected in January 2020. The next thing which is key to note at this point is that the World Economic Outlook projections are with a higher than usual degree of uncertainty around the forecasts. And this is of course due to the key assumptions which you make in your model in order to try and predict what will happen. So for instance here, the baseline projection rests on key assumptions about the fallout from the pandemic. In economies with declining infection rates, the slower recovery path in the updated forecast reflect persistent social distancing into the second half of 2020, greater scarring, meaning damage to supply potential from the larger than anticipated hit to the activity during the lockdown in the first and second quarters of 2020. And if we then scroll a bit further here, we will see latest economic outlook growth projections. So for instance, in the euro area, minus 10.2%. And if you have seen any financial news this week, you will most likely have seen a breaking news article with this double-digit negative growth outlook for 2020. Remember, this is still projections, but it does for sure not look good. And the United States at minus 8%. If we scroll down here, the only country which will actually manage to have a positive GDP growth is China, and they are still severely down compared to the year before. And this is still just on the highlighted sections of the report. If we go in and take a closer look at the actual report and scroll down to page 4 on commodity prices, the assumption on fuel prices are broadly unchanged from April 2020 from the World Economic Outlook. Average petroleum spot prices per barrel are estimated at $36.2 in 2020 and $37.5 in 2021. Oil future curve indicates that prices are expected to increase thereafter towards $46, still about 25% below the 2019 average. The reason why I have chosen to highlight page 4 and the commodity prices, and in this particular case the oil, is that it's the only commodity which I have in my portfolio, and it is of great importance to know what they expect from the oil prices, to know if you should consider buying more or if you should consider getting out of your position. Of course, this is just an overall level and there will be much more research to do, but just to have an indication of where you should prioritize your time. For instance, if they're saying that oil prices are going to stay low for a long time, well then I probably shouldn't consider buying more. The last thing that I want to highlight from this report is, if you scroll down to page 13, you will see two different scenarios. And this is due to the fact that there is so much uncertainty regarding the estimations. So in scenario 1 here, a second global outbreak in the early 2021, and scenario 2, a faster than anticipated recovery. So if we look to the graph here and see if we have a faster than anticipated recovery, the GDP of course will recover much faster, and if we have the first alternative scenario where we have a second outbreak, we will see a huge decrease in the GDP, and the same is the case for the oil prices. So that was by far the most important financial news item we have seen within the week, at least from my perspective. Of course I could have highlighted others as well, but I would have decided to focus more on one particular and go more in depth with that specific news item. Next Sunday we will probably be talking about the US unemployment rate, since the king of key figures, meaning the non-farm payrolls, will come out Friday, the 3rd of June. Now, let's take a closer look at my portfolio and see what has happened within the week. So first of all, based on the news item that I chose to focus on, it should come as no surprise that my portfolio is down in value, since it was worse than expected news that we saw, hence that affects the market, and my portfolio is in the market, so of course I will be down in value as well. So last week my portfolio had a value of 58,900, now I'm down to 56,300, and that is despite the fact that I have added $500 within the week, so my portfolio has actually lost $3,100 within a single week. So let's talk about where I have actually deployed $500. I did 2 purchases and I did them Friday. I did a buy of $250 into Pfizer and $250 into Verizon, since I think that I will still see a lot of value here, and I think that the dividend is quite secure. So this fits my strategy, hence I keep adding more, since I would like to hold bigger positions in both of those companies. Unfortunately, I didn't receive anything in dividends this week, hence all the $500 was fresh capital. And as I mentioned in the beginning of this episode, there is a lot of news updates within the portfolio. So I will go through a lot of them, and some of them I will simply have to leave out, otherwise I think that this episode will become way too long for my taste. But I still think it is important to highlight some of the news items for the companies which I hold in the portfolio, just to give an idea of what I'm actually looking at. So let's start by looking at the first news item regarding Carnival Corporations. So S&P has downgraded from BB- to BBB-, meaning that they now have junk status, which is really not good. At the same time, Moody was out and they have been downgraded from BA1 to BA2. If we then move to the third news item for Carnival Corporation, they have extended their operational pause through September 30th. So due to the outbreak of the pandemic, they are forced to stay shut down longer than they have initially anticipated, which is really not good. If we then go and take a look at the fourth news item, they are pricing in 2 senior secured term loan facilities, so they are trying to secure more cash in the business so they don't run out of capital and hence has to go bust. As I have pointed out in a previous episode, they have capital for little less than 1 year before they would go bust unless they're capable of cutting costs. So what we are seeing here is that they are securing more money so they would be able to operate for longer. So that was 4 news items just for Carnival Corporation alone. The next news is that Exxon prepares job cuts across US offices. The cuts are expected to be performance-based and are not characterized as layoffs, within 5 to 10% of US employees who are subject to performance evaluations reportedly seen leaving after their assessments. Not all workers are subject to such evaluations, which typically apply to white-collar jobs such as engineering, finance, and project management. So as I mentioned, when we looked into the report from the IMF, we are seeing that the oil prices will stay low, hence the oil producers has to do something about their costs. And this is what we are seeing here. Then we move on to Disney. Disney World holding line on reopening plans despite case spikes. So Disney World in Orlando are still holding on to their plans for reopening despite the fact that we have seen a spike in the pandemic. If we then move on to more positive news for Disney, they are adding 8 European markets on September the 15th. I'm really happy to see this because I expect a lot of growth in the Disney Plus channel, but this particular news is much more important to me because when we look at the countries which will be added on September 15th, we have Portugal, Belgium, Finland, Iceland, Luxembourg, Norway, Sweden, and Denmark, which means that I will be capable of subscribing to Disney Plus from September 15th, and I can actually see the price of 59 Danish kroner. Then we have a very short announcement from Starbucks, since they have declared a dividend which is in line with previous, which I'm currently really happy about, because as long as they keep the dividend, you will keep holding on to the company. So there's ex-dividend 6th of August, so remember, if you want to have part of this dividend, you need to have the stock in your account on the entire August 6th, so I would prefer to buy it at least the day before. And this will be payable of August 21, and we can see here with the current price that the forward yield is 2.23%. Then we move on to short news from Verizon, which are expanding 5G home internet, and they are expecting to have 10 cities nationwide by the end of the year where they will be delivering 5G. And this is really a positive news, since I am expecting a lot from 5G as well. That is one of my reasons for holding Verizon in my portfolio, since I want exposure to that as well. Next we have Macy's, which have announced major job cuts. They expect to create a cost saving of around $630 million per year with a major restructuring initiative. So they are eliminating 3,900 corporate and management roles. So they are acknowledging the fact that they will be a smaller company for the foreseeable future. The cost saving of 630 million comes on top of the 1.5 billion that they have already announced back in February, and they expect this to be fully realized by the end of 2022. Then we move on to the news related to the financial stocks in my portfolio. So Wells Fargo analyst Mike Mayo explains on CNBC that he is both super confident and super worried at the same time, as he advocates for no dividend cuts in the stress test, but we shouldn't expect to see a dividend raise either. Then we have an announcement from Fed where they are capping large bank dividends and banning share buybacks in Q3. So Fed tells banks that they must keep their Q3 dividends at the Q2 level and forbids them from buying back shares in Q3 as well, in order to preserve capital. So despite the fact that the stress test didn't say anything about dividend cuts, we are seeing that they are actually imposing a rule that they are not allowed to raise the dividend. They have to keep it at the Q2 level in order to preserve capital. And it actually goes one step further. All large banks will be required to resubmit and update their capital plans later this year to reflect the current stresses, which will help firms reassess their capital needs and maintain strong capital planning practices during this period of uncertainty, the Fed has announced in its statement. One important thing to note here is that Lael Brainard objects to allowing banks to continue paying out dividends thanks to the change in the financial conditions caused by this pandemic. So she objects that it would actually be better if the Fed halted the bank's dividends so they would equalize the playing field and not allowing any one of them to pay out dividends, and by doing so none of them would suffer from a competitive disadvantage by paying out dividends, and then they would preserve more capital if the situation turns out to be worse than we are currently expecting. Next, we have a positive news for the financial industry as a whole, since they are climbing higher after there have been a change to the Volcker rule. If you are not familiar with the Volcker rule, I will of course include a link in the description below, but I will also try and give a little explanation to it here. So first of all, the Volcker rule refers to Paul Volcker, a former chairman of the Federal Reserve. I will of course include a link to a description of Paul Volcker as well, since he was the 12th chairman of the Federal Reserve. So, in short, the Volcker Rule is a federal regulation that generally prohibits banks from conducting certain investment activities with their own accounts and limits their dealings with hedge funds and private equity funds, also called covered funds. The Volcker Rule aims to protect bank customers by preventing banks from making certain types of speculative investments that have contributed to the 2008 financial crisis. So in this particular case, the FDIC has approved adjustments to the Volcker Rule, allowing banks to invest in venture capital and credit funds. And if you do not know what the FDIC is, then it is short for Federal Deposit Insurance Corporation. And for a more detailed explanation, please see my last video, where you will also find a link in the description to read more about it. So the regulators are also changing the requirements for banks to post margin for trades between affiliates, which could mean billions more at disposal for the financial institutions. On Friday, I received this news item where there's an analyst from KPV who has had a chance to take a closer look at the stress test from the Federal Reserve, and due to the resubmission of capital plans, he sees that it is more likely that Wells Fargo and Goldman Sachs will have to cut their dividend after Q3. And finally, the last news item that I want to cover is that Taubman shareholders approved the merger with Simon. So Simon Property Group may not want to buy Taubman Centers anymore, but the Taubman shareholders have voted for that the deal stays in place. About 99.7% of Taubman shares voted in favor of the merger agreement and related transactions, which constitutes 84.7% of outstanding shares entitled to vote. So for those of you who are not familiar with this, Simon Property set out a proposal to buy Taubman Centers, but then we have the outbreak of the pandemic, and then Simon Property saw how Taubman was affected, and that was much worse than expected, so they actually wanted to terminate the deal and did no longer wanted to buy all the centers. So that concludes yet another exciting week on the stock market. So now you have seen the new updated report from the IMF with regards to the world economic outlook. You have had an introduction to the Volcker Rule. There will be the link in the description as mentioned, and there was really a lot of news items. So feel free to comment, like and subscribe, and until I see you next Sunday, bye!